people. Welcome to Private Equity Laid Bare, the podcast. Today, our guest is Matteo, and we are going to talk about how to value infrastructure investments. And first of all, thank you so much, Matteo, for joining. Please say a few words about what you do in life and a bit what you're going to talk about today.
Hi, Ludo. Thanks for inviting. I'm a managing director at Goldman Sachs, and specifically, I work in the asset management division. And within that, I'm in the part that does alternative investments, where we have about $140 billion of assets under management across both private equity and private debt. Within the equity sleeve, we have several investment strategies, including infrastructure, where I sit, but also traditional private equity, real estate, growth equity, etc. In infrastructure, we've raised over $12 billion over the last 15 years. And I'm responsible for both buying and selling investments in Europe and managing our portfolio companies, sitting on the board. So for better or for worse, I've been involved with infrastructure for a long time. I started 20 years ago, originally doing infrastructure financing, and last 15 years doing infrastructure equity. And I really like it. You invest in something tangible, you contribute to the economic growth, but you can also help protect from long-term risk like climate change, for example, by investing in energy transition.
And in terms of fund size, what would be the size of your latest fund in infrastructure?
So our latest fund was $2.5 billion. We just, we're finishing investing that.
Okay. And so what are the key tricks that our listener needs to know about valuation in general, but specifically about infrastructure?
Yeah, I think, it's there's a number of things which are specific to infrastructure valuation, and we'll get to those in some details and with some example from real life. So we'll cover things like discount rates that are used by different types of infrastructure investors, and rebuy IRRs, which is something typical of infrastructure, which you may not find in valuation of other asset classes. If you got the patience to listen to the whole conversation, we'll have some real life examples taken from situation where I've worked on, and where I'll try to show some of the challenges doing infrastructure valuation, and also things you can do to prevent those mistakes.
Excellent. That sounds amazing. So is it the same approach for any kind of real estate investments? Infrastructure investment, sorry, or and it will be the same for real estate, or are there different type of infrastructures I need to be aware of that would have differences in methodology or things like that?
There are different types, and I'll try to simplify using sort of the jargon that people in the industry use, which is similar to real estate. And so I would break it down in 4 categories of risk return profiles: super core, core, core plus, and value add. Super core investors target the lowest risk businesses with a levered IRR, call it of 6 to 9%. Core investors would target 9 to 11%. Core plus are usually 11 to 13%, and value add 13 to 16%.
That would be in today's environment, right? Given where the interest rates are and where the prices are. So some people are still targeting 13% plus, which seems punchy.
That's right. Sort of in this scale, I would have in mind a private equity investor at sort of 20% plus, which maybe in today's environment, is not necessarily the case. Sometimes, you see private equity going lower and getting closer to infrastructure, which is happening more and more.
And these are gross of fees, right? So that's probably an important point as well.
That's right. And those are the gross figures that a fund would target, and they're also the gross figure that a direct investor would target. Generally, I would say, the lower the IRR, the more of the returns come from yield rather than from capital appreciation. And also, the more you have direct investors as opposed to fund. Broadly speaking, the funds are, some core, but core plus and value add. And the direct investors, they tend to be in the lowest risk sub asset classes, because there is less scope for a manager to add value in those lower risk assets.
Yeah, I think it's not so much of a risk. I think it's because they think that this is simple enough for them to do it directly, and so they don't need to pay Goldman Sachs to do something that is seen as simple enough, and so then they just buy it directly, right? So these are like the pension funds buying directly a super core, because why would they pay someone else for something they can handle? But when it comes to value add, then you guys have something special, some specific knowledge, etc. And so they have to delegate that. They have to outsource these kind of investments to specialized managers like you.
That's right. Obviously, this is sort of in general terms, when you invest in certain times of the cycle, when things get difficult, then even a super core asset can get tricky. But broadly speaking, there is definitely less requirement to have a hands-on asset manager, to invest in something which is very low risk, like could be a water distribution company, as opposed to a complex asset which perhaps needs to be built and fits in the value add category.
And this is where it's a bit different from LBOs or venture capital, etc. in terms of valuations, is that in real estate and infrastructure, you get a sense a bit of where the asset is in terms of risk profile, and then you have a target rate, and that's your discount rate, and you're going to do like quasi-standard MBA thing of like discounting the cash flows with a discount rate, right? So you have a sense of what the risk of this investment is. You have a discount rate that corresponds to it. You have done a lot of the work. While for venture capital or buyout, it's pretty difficult to do these sorts of things. So this is probably what one first big characteristic of doing valuations in this context.
True. You look at the sort of target business, and generally you self-select. If you are a fund investor like we are, we are GP managing sort of core plus value add risk profile. We kind of self-select the businesses that we look at so that they fit that category. And so we look at targets where we kind of have a sense of what the return is. We just have to, within the range, we just have to pick the right level that we think is appropriate, and then we use that as the rate to discount the cash flows. And then we make an assumption on exit value. We do use multiples as well. They are a quick and easy.
By multiples, you mean comparables, right? So what people would use quite a lot in other sectors. So comparable companies' financial ratios, and to compare with theirs.
Exactly. EBITDA multiple would be typical. It would be a RAB multiple for regulated utilities, but they're just a quick and easy indicator and a comparator. But obviously, it's not the core. The key valuation tool is the discounted cash flow analysis.
Yeah, and infrastructure was very much the tool. The other difference, I think, compared to venture capital and especially leverage buyout, is that you have also a longer horizon, and it also ties in with the fact that your financial models typically look at a longer time period. So when you're doing projected cash flows, you sometimes go like 7 years, maybe 10, and that also is a big difference with leverage buyout, where you have like a 3-4 years plan, and then you need to make assumptions about where the world would be in 3-4 years. While here you seem to be using longer horizons usually, no?
Yeah, that's right. Our investment horizon would generally be 7 to 10 years. But what is interesting is that we always trying to forecast our business for longer than that, because one of the ways of estimating the exit value, as opposed to just applying a multiple on an EBITDA or another metric, is to use the rebuy IRR concept, which is basically saying what is going to be the return target, the discount rate used by the new buyer at the time of exit, which will have to reflect the risk of the business at that point in time. But it also requires having a set of cash flows from the exit until a later date, call it at least 10 or 15 years longer, if not more, to apply the discount rate on those cash flows.
So you don't quite do the infinity formula we teach MBAs, which is, like at exit, this investment will grow at 2% forever and ever, and then here is the number, right? You don't quite do that. You do this reinvestment IR, saying after 7 years, there's somebody who's going to pick this up for another 7 years. What is this 7 years looking like? So if you don't change the risk profile of your investment, so if you like super core and it stays super core, it's the same discount rate for the rebuy IR as your discount rate. But if you change the risk profile, you have to take that into account. Is there other things we need to be aware of difficulties of because you can not really even say what's going to happen next year. So how do you know what's going to happen in 7 or 10 years, 15? That seems tricky.
Well, what I would say is that if you're really doing sort of infrastructure investment and you're selecting the targets so that they have good infrastructure characteristic, they should be, by definition, those targets, they should have significantly higher than average ability to predict cash flows, because that's exactly what investing in infrastructure is about, having something which has a lower risk profile and therefore a better ability to forecast. I think you made the right point that if you're not changing the risk profile of the business, then the discount rate should be the same. The rebuy IRR should be the same as the target discount rate initially. Those two things should be consistent. However, for a fund, particularly a core plus and value add fund, a lot of the investment thesis generally in infrastructure is about de-risking an investment. Okay. So you buy something that initially is core plus or value add, you try to work on it to reduce the risk so that you can sell it as a core, or even better, as a super core.
And then the basic intuition here that some people often get wrong is that if you de-risk, the price will be higher, right? So if you bring the risk down, it means the discount rate is lower, which increases the price of the asset, right?
Exactly. So that should be how one way to create value. Obviously, the other way is to grow the business and grow the EBITDA and have a bigger company at exit. But de-risking is sort of a big part of the theme for a fund investor. It's probably less the case if you buy super core. There's not much you can de-risk.
Yeah, it's already
the question there is, are the interest rates at exit in 7 or 10 years going to be as low as they are today? And I think that's a big question.
Yeah, I was going to bring this up actually, because you have these target rates, and I said it also when you presented them. I said, well, it's in this current environment where basically the LIBOR is at zero, the base rate is at zero. But if you were anticipating by looking at the yield curve, maybe that in 10, 15 years, the consensus is that interest rates would have gone up by 2% or so, you could have a case for saying, the rebuy IR would be this target now, even if I don't change the risk, plus 2%, because I expect the interest rates to go up.
Yes. I think generally it's fair to say that the infrastructure is it's inversely correlated to interest rates valuation, and therefore you should do that if you think interest rates are going to be higher.
Yeah, and the classic case of de-risking, I guess, in your world, and trying to use some classic infrastructure vocabulary, which I sometimes get wrong, is like this greenfield versus brownfield, right? So I guess greenfield is if I remember right, is when something is green, so it was like it's kind of new, so there is no assets in place, and so you would do a greenfield investment, but then by the time you exit it, it has become a brownfield investment. So everything is in place, and therefore then it is a lower risk. Did I get that right, or I inverted greenfield and brownfield?
No, that's spot on. Greenfield investments are when you build something which doesn't exist and so doesn't have cash flows, while a brownfield would be when the asset is up and running and generate cash flows. It's a lot harder, and goes without saying, it's a lot higher risk to do something greenfield, even if you're building the most sort of obvious infrastructure, like a road. It's clearly a piece of infrastructure.
Yeah, you never know. Yeah,
forecasting the traffic, it's very hard, and so
we have a great example in the UK, or a terrible example in the UK, with the M6 project, right, where it has been pretty terrible.
There's plenty of example. I mean, those are the infrastructure assets that go wrong. When you buy a road that is brownfield, the traffic can move. We've seen the biggest shock ever, with the pandemic in 2020. But the reality is that it is significant. The band where traffic can move is significantly narrower.
Yeah.
But it's when you're building new, it's very hard. I don't think necessarily the greenfield risk gets priced in the most accurate way, but that's a separate and much longer discussion.
Yeah. Excellent. And maybe it's always easiest to think with an example. So do you have a deal you worked on that you could bring as an example where you could walk us through how you valued it?
Yeah, I have a couple, but let me start from one, which is a company that we built in 2010 in Spain, called Redexis. It's a gas distribution and transmission company. So it is a regulated utility. It owns the gas pipelines that you would find underground in the street. The company doesn't sell the gas, just owns the pipelines and gets paid a fee by the supply companies, which are those that are selling the gas, for letting transport. So three things at the time made the investments interesting for us. First, unlike the UK, where gas pipelines are nearly ubiquitous, in 2010, only 28% of Spanish premises were passed by a gas grid, meaning that there was a huge addressable market to build in, and the government was keen to incentivize private investments to do so. So there was a big growth opportunity. Second, the transaction was a carve out, meaning it was the sale of a division of the seller, who was a large energy company called Endesa, mostly focused on electricity rather than gas. So in other words, the target had suffered from lack of attention from top management. And so there was scope to make it better. And number three, the company was in Spain, and it was 2010. The financial crisis was pretty tough at the time, meaning there was less competition to buy that company. So from a vintage perspective, you knew that you were buying relatively well. So if you fast forward 8 years, which was the length of our investment, we did what we expected to do and even more. We deployed a lot of CapEx in that white space.
Can you say what deploying a lot of capex would mean?
So we built a lot of pipelines in the portion, the 72% of Spain that did not have a gas connection.
So it was not that trivial an investment. So you did acquire this company, but one of your value add is the fact that you had deep pockets, meaning that you could then draw on some more capital to invest more into a company to put more pipelines and the like.
That's right. And so just to put it simply, back to your sort of greenfield, brownfield terminology, what we built was a brownfield business because it was already up and running, but we had identified a very significant greenfield opportunity that was attached to it. So we were able to use cash flow that was generated by the existing business plus additional capital that we put in to expand. And, over the period, we ended up increasing the EBITDA by 2.5 times.
But with some add-on acquisition, so not just organically, right? So
we did, yes. 2/3 was organic and 1/3 was inorganic. So we did add-on acquisitions of small businesses, which
so that's a big increase in EBITDA for organic, right?
Yeah, there was a big increase, essentially linked to more capex, just more investment.
And you had and your margins, did they also go up or?
Yeah, the margin, we were able to increase it from 59% to 75% EBITDA margin.
What kind of margin is that? Is like you had margins of 75%?
It's a good margin. That's what you would have generally in infrastructure, high EBITDA margin. I know compared to private equity, it's enormous. And the reason why you have
it is. Even Elsevier doesn't dare to have such margins on their products.
Yeah, well, the reason is that infrastructure is very asset intensive, so there's a lot of capex, and therefore the margins are very high.
Okay.
And so combining all those things, we had a phenomenal CEO who was able to run the business more efficiently, so did
you source the CEO? Because one of the themes is a bit to try to see how people add value. So did you source the CEO yourself, or was the CEO in place and you were just lucky that there was a good CEO in that company?
No, we sourced it ourselves.
Okay. So that's thanks to your network then. That's one of the benefits of being Goldman Sachs.
Yeah, we within I would say probably 7 months into the investment, we knew since the beginning that the management team was good, but it was a team of engineer with less of a sort
never
of
good, never let engineer run anything.
Well, let's say, fantastic from a, an asset management perspective, but, less with a value creation mindset. The pipelines were of excellent quality. Sometimes you'd argue even too high, maybe, a bit gold plated. But I think we needed to have, somebody with sort of an economic and value creation mindset.
Yeah, that's great.
And that's what the new CEO brought. He sort of slowly brought on board a number of other people to help him, and the results were pretty amazing. And on top, we were able to do a refinancing along the way, slightly higher leverage, which was very accretive. And then we exited the business by selling it to direct investor, a consortium of 3 direct investors, 2 pension funds, and a sovereign investor, which had a long-term approach, and therefore used the slightly lower discount rate.
Yeah, so classic infrastructure exit, like we said, you started with something that well did trivial, but was not completely trivial because you could expand it, so it was kind of value add or not quite, and then but you could exit it as like super core or core at least, and that enabled you to get some more money thanks to the change in discount rate.
Indeed.
So do you want to walk us a bit through how you approach the valuation of that asset? We are running a bit out of time, so maybe we go to the valuation part.
Yeah. The valuation was what we explained. So we had the discounted cash flows for our investment horizon, and then we had the exit value, which was estimated with the rebuy IRR methodology. I think the thing to always pay particular attention is the rebuy and the exit, and because it's very easy, it's probably the areas where it's the easiest to make a mistake.
But here, you need to know at the beginning that you're going to exit it to a direct investor as a core plus investment. So you need to know that plan from the beginning, right? So you need to have worked it out from the beginning. Otherwise, you don't know what to do as a. This is where it's interesting. Like I often emphasize that to my students. You need to do these exercises in a coherent way. So if you are going to have as a strategy what you just described, then that's going to influence your valuation, because your exit strategy is going to be influenced by your value add strategy. And therefore, your valuation is tied in to what you plan to do with this investment, right? And it's not like one team is doing the valuation in isolation to the team who's doing the strategy. So here, or you feel that there's a good likelihood that you're going to exit it as a core plus investment, and then that gives you a right answer for the reinvestment IR.
I think that's right, and that's where it helps. For a financial investor, you just have one team that is across everything. Sometimes, a corporate buyer might not have that. They might have a much bigger team involved in an acquisition, and you would have the M&A team, which is doing the financial analysis, and the operational team that would do the business plan. And so you might have that risk of lack of coordination between the two. As a financial investor, you've got a pretty lean team that is just across all the different things. So you're spot on. Your exit strategy is influenced by what you do during the life of the investments and what your plan is. And so if you plan to de-risk it, to position it better for exit, then it's all consistent, and you can underwrite to some extent a better exit. What happens, and what was the case in sort of that Spanish investment, because we were buying in a time of crisis, generally at that point, the word is conservative, because you are, given what's going on, people are influenced by the dynamics, and so you end up being more conservative on the very long-term forecast. When things are going very well, think of 2007 to some extent, think of 2019, to people and the environment tends to be more optimistic about the very long-term cash flows. And that's how people justify higher valuation. I remember looking at a toll road company in 2007, where there was the long-term traffic forecast was 3.5% in perpetuity, which the business at that time was growing 8% per annum, so it didn't feel that high. But it turned out to be completely wrong. And when you do 30-year forecast and your growth rate is probably twice what it should be, the difference in valuation
It's
becomes
huge.
enormous.
Yeah. And so we said earlier that we use DCF, so net present value with this discount rate, etc., for valuation infrastructure because we feel we can forecast the cash flows. So let me ask you the question a bit cheekily: is that when you wrote this model in 2010 and you projected the cash flows, now you sold the business, I guess. Well, you did. And so, did you get this cash flow projection pretty accurately, or were they off?
I think the cash flow projection, the investment I told you, was about 8 years. We were, not too far. Where we got it wrong was after 8 years, we had forecasted the business to have very little growth. In reality, when we sold the business was forecasted to have a lot more growth. And that was actually very beneficial because we were not counting on the ability to continue to grow. And therefore, we sold a stream of cash flows that was much higher in value than we had anticipated.
Okay, no, that's great. And would you have another example where you couldn't quite do this? So here we saw it feels like a textbook example of infrastructure valuation and deal. Do you have a case that wouldn't be as standard?
I have a case of that is sort of less standard, which is an investment that we still own. We made it in 2018. It's a company called City Fiber. What they do, they build full fiber networks around the UK. So for those that like the telecom jargon, we build FTTH network fiber to the home. When we're looking to buy City Fiber in 2018, there was only 5% of the UK that was covered by full fiber, so pretty much nothing. While 100% of the country is covered by a copper network, the traditional telephone lines that you would get from British Telecom. And that the future is about getting everybody connected to full fiber. The government has very ambitious target to do this. So somewhat similarly to my example of Redexis, there was a very large growth opportunity. The difference was that in Redexis, you had a greenfield and a brownfield component together. In the case of City Fiber, the EBITDA was close to zero when we bought it. So it was pretty much entirely greenfield, but the company was listed and had a market cap of 375 million pounds, give or take, in anticipation of the value that would have come from the future opportunity. And it was about 100 million pound of cash on balance sheet.
So that's pretty wide, right? So you're going there. This company is already listed. We like to think, at least academics do, that the stock market is not completely stupid. So if I put the valuation at 400 million, is that it's in the ballpark of right, including all the growth prospects and the like. So the market is not dumb. So even though they're making no money, the market is saying it's still worth 400 million. And you guys go there and are going to pay a premium. Usually it's 30-40% to delist it, which is a huge premium. To recoup 40% value, it's a big deal. So you're going to put 40% extra on the table to get this company off the stock market, which is already valued pretty highly. It's 400 million for a business not making any money. So how did you come up with a justification? So here's a different setup: a justification that, well, the stock market is saying this is worth 400 million. We are going to argue it's worth 500 million. And here is why. It's kind of like a reverse exercise. Now the valuation is fixed. Now you need to play with your Excel model to justify why would you pay such a crazy price that the market is saying is worth less.
Yeah, and you can imagine that we had a pretty robust discussion at our investment committee when we asked for approval to spend more than 500 million pounds to buy a company that was making no EBITDA in the infrastructure business. So yeah, it was pretty tough. But you're right. In general, the market should pricing correctly. But I'd say in general, I find that is less and less the case for businesses that are very hard to forecast, because it was hard for us to come to do evaluation of City Fiber, let alone for the shareholders with very limited public information on the company. A business that it's all about growth in the future, where the management is not telling you those forecasts, how can you apply the right valuation? So the market was kind of basically valuing it on a good feel. There were 3 or 4 brokers that were covering the company with I remember a range of price targets that was incredibly wide, from a total sell to a buy that was 3 times the share price at that point in time. So an enormous range, kind of showing the challenge for a public market investor to value a greenfield infrastructure company. So what we thought was that we liked the opportunity. Fundamentally, we thought that fiber was going to be the future. There was going to be a big push for it. There was going to be a lot of demand because it would have become more important both for consumer, for businesses to have better quality connectivity. Nobody was forecasting COVID and the big push in digital infrastructure demand that has.
Yeah, this was like bingo for you.
That for us, yes, it was a push, but the reality is that we were already betting on that trend to happen, probably at slower pace. COVID just accelerated that tremendously. So we came up with our set of cash flows, and we apply our discount rate, and then we thought we're developing a business from scratch, so there's greenfield risk. We need to get paid for that, but once it's up and running, this company should be very valuable. It should become the fourth utility. So if you think,
so even though it was like a venture capital style investment, you still felt that you could say what kind of cash flows would come out of it, and you guys still felt more comfortable approaching it from an NPV DCF perspective than the usual VC perspective, which would have been, let's take a multiple and add to it. And
that's right. The challenge for that is that people would still look at the EV/EBITDA multiple at acquisition, and that made no sense. And so that was explaining that you couldn't do it. It wasn't an easy discussion, but ultimately the committee recognized the value of the opportunity, and that it was fairly remunerated for the risk of developing. I think with hindsight, we were prudent at the time. The opportunity that we ended up finding was much larger than we had anticipated. So the company will grow a lot more because it will build a lot more fiber than we were comfortable underwriting at the time. So it went in the right direction. I think we still have to see what the outcome is going to be, and only time will tell. But I feel pretty good that the direction of travel is the right one.
Well, thank you so much, Matteo. We are way out of time, but it was totally worth it. It was really awesome. So thank you so much for joining. This was Infrastructure Investment Valuations laid bare. Don't forget to subscribe. Congratulations on your acquisition of one more piece of knowledge. Ciao, ciao, everyone. And thank you again, Matteo.